Escrow can be a scary and confusing term for many first-time homebuyers. And this isn't because it's an actually complicated concept, it's just because the term escrow can refer to a couple different things. In general, an escrow account is any account that is held by a neutral third party to a transaction where funds are held until all terms of the contract are met, after which those funds are dispersed to the appropriate parties. When you go to buy a home, you will leave an earnest money deposit before closing. This is a small percentage of your down payment that you pay in order to show that you are serious in moving forward with the transaction. When you close, this money gets applied towards your down payment and reduces your total cash to close. This money is held in an escrow account, so that way, when you actually do go to close, the money can be applied to your down payment. Now, in the context of a loan, the escrow account generally refers to an account that is created by your lender that you pay into each month with your monthly payment, where they hold those funds, and once a year they will pay your taxes and insurance. This is essentially a savings account that you pay into each month so that you don't have to worry about paying those taxes and insurance when they become due, and you pass that responsibility off to your lender. Property taxes and insurance costs can change over time. Your lender will perform something called an escrow analysis once a year. This is where they will look at your escrow account and look at your current balance to see if you will have enough money to pay your taxes and insurance when they become due. So let's say your taxes and insurance are due in 4 months when your lender performs this escrow analysis, and they gauge that you're going to be $200 short. Then they will increase your monthly payment by $50 in order to cover those costs. On the flip side, if they notice that you have an overage or you have too much money in your escrow account, they will refund that money to you in the form of a check or direct bank transfer, depending on how you set it up with that lender. So if you see your monthly payments changing and you haven't refinanced, it is probably because your property taxes or your insurance have changed and your lender has adjusted the amount that you pay into escrow each month in order to cover for that. Another things lenders will do to avoid a situation where you don't have enough money in your account to pay for taxes and insurance is that they will require you to have 2 months of reserves in your escrow account for taxes and insurance. That is why when you close on a purchase or a refinance, you might see sometimes that more than 12 months of taxes and insurance are collected. This is just so that you have some buffer in case costs increase unexpectedly. Now, if you want to avoid an escrow account, there is an option called the escrow waiver that is available for certain borrowers and certain loan types, typically having over 20% down, where you can tell your lender that you don't want the escrow account, and instead, you will pay those taxes and insurance yourself. Now, this sometimes will come with a slightly higher rate, and it'll also require that you pay those taxes and insurance on time to avoid any late fees. So for most people, it makes more sense to just pass that responsibility off to the lender and automatically take those costs every month, instead of having to remember to save up to pay the taxes and insurance and maybe get surprised by a bill that they weren't expecting. Now, you may be wondering, what happens to my escrow account if I refinance my home or if I sell my home? Well, in that case, your old loan is paid off, so any money that is sitting in that escrow account gets refunded back to you either via check or direct bank transfer. This is why when you're refinancing, the escrow costs that are loaded into the new loan are not really costs, because you're going to get the money that was in your existing escrow account back, because that was your money to begin with and it's always been your money. So you'll get that back, and that usually offsets that cost of the escrows that are paid at closing for the new loan. So to recap, an escrow account is just any account that is held by a neutral third party to a transaction that is used to hold funds until a deal is closed, after which those funds can be dispersed to the appropriate parties. In the context of a mortgage loan, it's typically talking about your escrow account that pays out your insurance and your taxes that your lender holds for you, so that you don't have to worry about paying those each year when they become due. Now, as always, if you're based in North Carolina and you have any questions about mortgages or you're looking for a rate or a quote, you can reach out to me at the link in my bio.